It's Bloomberg's Open. I'm Manus Cranny, in for Jonathan Farrow. You've just heard from the President, Christine Lagarde. Data. More on that in just a moment. I want to set the stage for you on the equity front. This is what we've got for you. A nice, strong bid to equity markets this morning. It's day two of Jay Powell's testimony. The ECB leaves rates on hold. Powell did not embolden the no camp, less than 3 cuts narrative. The commercial real estate market is manageable in terms of leading stocks this morning. Again, that cap fits on NVIDIA, bolstering the technology bid up nearly 1%, 18,185. Yeah, there are 2 directors in the NVIDIA camp who are selling stock. They've been on the board since 1983. NVIDIA is bid. Stocks are strong. Let me just show you the reflection of what came from the ECB. This is where, in the very first instance, traders began to reprice 100 basis points of cuts this year. The growth outlook for this year was cut by the ECB. They talked about inflation coming to 2% in 2025, a dovish hue. Christine Lagarde came out and subtly but deftly unwound those bets. She talked about a gradual pace. She talked about a situation of where we don't have enough data. We won't have enough data in terms of movement. We will move before the core hits 2%. She needs more data to be more confident on moving. That sounds more like June. And in terms of a commitment to the pace, and this is something we must all get a hold of globally. There's a holding season that moves to restrictive, then you move to normalization. She will not commit to a pace, a rhythm, or a magnitude of cuts. And that is a global caveat we all need to grasp, from the Fed to the ECB to the Bank of Japan. Let me show you the immediate ramifications across the bond markets as well. In the very first instance, we saw a more significant drop in yield across the Bund, the Bobble, and the Schatz, 2s, 5s, and 10s. That has been unwound now as she talked about the concern about wages remaining hot. And that is 4.5% on wages, sequential core at 4.3%. The warnings were there in terms of the ability to move. They are not there yet. Christine Lagarde weighed in on the ECB's decision.
There are signs that growth in wages is starting to moderate. In addition, profits are absorbing part of the rising labor costs, which reduces the inflationary effects.
Joining me now to discuss is Invesco's Alessio De Longis and Winnie Sizer from Credit Insights. Winnie, to you first of all, this is a deft president. The market got all doved up on the headlines, and she came out basically, I think, giving the narrative that all central banks want to communicate, which is we're not there yet, we don't have the data yet. And if anything, this was a very clear narrative to the markets that central banks are so fearful of moving early, isn't it?
I think so. And I do think that Lagarde benefits from the hindsight of the December Fed press conference, where Powell came out much more dovish than we had anticipated. The market really took that, ran with it. Financial conditions eased considerably. And central banks have not seen the progress on the data that they want to see to start to really talk about cuts being on the table, even though the market really continues to presume that they are.
Indeed. And in terms of that pro-risk narrative, and this is the point, Alessio. Again, all of these markets are in a pro-risk soft landing mode, aren't they? But the more that we hear from central banks, the more hesitation there is imbued in risk.
Yeah, correct. The first push towards risk was really driven by this expectation that would be meaningful and aggressive cuts. As that view didn't materialize, as you alluded to, didn't materialize really anywhere yet, markets are still showing that resilience because ultimately they found the comfort zone with growth that is stable and improving on a go-forward basis. We saw it also in the projections for the ECB. While inflation, yes, it's not falling as rapidly as hoped, but it is at 2% on a projected basis. Basically, inflation is no longer a risk factor for the market. We talked about that Goldilocks scenario. That continues. No news is good news.
A very quick response from both of you. I want to move the agenda along to the US and to Powell, but very quickly, I had Allianz with me this morning, one of their chief economists, and basically said the biggest risk for the ECB is that the Fed does not move. Tail risk or real risk? Alessio?
The Fed not moving, I would call it still a tail risk. I more second your view from earlier, where I believe this cutting cycle for the major central banks is going to come somewhat synchronized, as you alluded to earlier. And that's also explaining why FX volatility, currency volatility is extremely reduced, with the exception of the Japanese yen. The Bank of Japan is the only central bank that is moving the other way towards rising interest rates. That could be the main story for the second half of the year.
It could indeed, and then we can debate whether that's one and done and what that does. Winnie, before we shift to the Fed, how important is it that the Fed goes before the ECB has the capacity to go? Because it's a danger, according to Allianz.
Yeah, so we have expected that the Fed is going to go first, just given the progress of inflation in the US versus the Eurozone until recently. Now, I think it's a little bit more of an even split. We do expect that the Fed should go as soon as May and the ECB perhaps in June. But I don't know that necessarily we need to see the Fed cut in May in order to see the ECB cut in June.
Okay, at the sequencing, let's see whether it is a concertina as always, or as it historically been. Okay, stay with me, team. We've got a little bit more fresh data out of the US today. Investors are gearing up for the second day of Fed Chair Powell's testimony and the US payrolls report. We're counting down to that. Mike McKee is with me. I don't know whether it's too early for the whisper number. Mike, good morning.
Well, the whisper number for tomorrow is pretty much what we're getting for the consensus number. I'll get to that in just a second. Here's the data from today. If you're looking for something to push the Fed one way or another, you're not getting it, because basically what we are getting is data that doesn't show much change in the state of the U.S. economy. Jobless claims, same as last week. Continuing claims go up just a little bit, but that's because the previous week was revised lower. January trade, the one outlier, a little bit weaker trade deficit, and that does subtract a little bit from first quarter growth. Productivity unchanged in its revision. So market looking at these numbers, I mean, we're pretty much status quo in the economy. So what does Jay Powell say today? Well, on rates, it's going to be the same story, you know, maybe sometime this year, but not yet. Bank regulations were big in the House yesterday. They'll probably be even bigger in the Senate today. Elizabeth Warren, Sherrod Brown, he'll say they're still reviewing it. Yesterday, he said, do expect changes. Balance sheet, he said yesterday, not an issue. QT continues. The one thing that didn't really get asked yesterday, might come up today, is on the U.S. debt. He said on 60 Minutes that it's unsustainable, but he'll take the usual Fed attitude of, you guys fix it, we don't get involved in this. You mentioned the jobs numbers, so let's see where we are now. February payrolls expected to come in at 200,000. The whisper number, 203,000. So Wall Street leaning pretty much with the consensus. Private payrolls up 160,000. That compares to the 140,000 private payrolls we got yesterday at ADP. No change in unemployment, and we do expect, or at least economists do, a drop in average hourly earnings on a month-over-month basis that pushes the year-over-year down as well. That would be welcome news to the Fed, which thinks that year over year we should be running about 3 to 3.5% for sustainable inflation. But that's the only kind of outlier in the forecast for tomorrow. Although, man, I have to say, 200,000 seems like a big drop from 353,000. But a couple of months ago, we were talking about 180,000 as a big number. So we're still looking at a very strong labor market.
Yeah, unemployment sub 4% and wages are strong. Mike McKee, thank you very much. My guests this morning are Alessio De Longis and Winnie Caesar on the markets. Alessio, to you first of all. I mean, you know, we start another day. It's been almost, let me just give you the fact. I mean, I was quite shocked by this. The longest streak without a 2% drop. I mean, this market is bolstered by investment liquidity and topped up by retail flow. Yet you have a concern that that there is going to be a moment of where we return to the mean. And you make this point. How soon will this market take a breath?
What we refer to a bit of a return to the mean is particularly to the biggest spread, the biggest anomaly that we have seen from a cyclical perspective, which is this outsized outperformance of quality mega cap tech relative to sectors and styles in the equity market that at this junction with improving growth and stable inflation should have outperformed much better, such as small caps, mid caps, value-oriented sectors. These cyclical sectors have lagged the cyclical move. That's the mean reversion that we are more concerned, actually not concerned, actually positioned for. But in this environment, the overall equity market and risk assets in general, including credit, we believe until something breaks, and it doesn't look imminent, investors, in our opinion, are still compensated to take risk, whether it's credit risk or equity risk. And it's only in the equity market that we would suggest a rotation in favor of cyclicals, expecting some mean reversion in the outperformance of mega cap tech.
So Winnie, it's the perfect world, isn't it? Nothing's breaking. Alessio's chilled. He wants to take risk. We're all bulled up pretty much every day. I don't know how much more bullish we can all become, but is there enough in credit for you? Is there enough return, briefly, in credit for you at the moment?
I would say on an all-in yield and total return basis, absolutely. Yields are still quite elevated, really globally across credit. It's that spread dynamic. How much are you getting paid to actually take credit risk that people are a little bit more wary of? And we've seen an interesting shift this year where triple Cs have been underperforming. Spreads are a bit wider there year to date, which is a reversal from what we saw in 2023.
Okay. Thank you very much, Alessio and Winnie. On the markets coming up, countdown to State of the Union with the details on what to expect right here on Bloomberg. Good morning.
This is probably the most important speech he's going to give the American people. President Biden right now is historically behind every single president except President Carter on 5 to 6 of the most critical metrics that we've relied on historically to gauge how strong a president's position is going into re-election.
President Biden prepares for a consequential State of the Union address. That's tonight, 9 p.m. Eastern. This comes as Biden faces mounting pressure on an array of political issues, including immigration and the economy, as well as concerns over his age. Anne-Marie Hordern is in the Capitol for us, tracking the State of the Union. Anne-Marie, good to have you with me. We've talked about the significance of this speech. I really want to drill into the content in terms of the key message. Good morning.
Good morning, Manus. Yeah, the significance is not lost on anyone. A lot of people in Washington are calling this, Greg Valliere this morning in his note, Biden's most important speech of his presidency, given the fact that it's not just a report to Congress and the American people about the State of the Union, but the fact of the matter is that what he is going to be pitching if he was to be reelected in the next 4 years. So when you get into some of the substance, what matters to the markets, we talked to Tobin Marcus earlier, and he talked about the fact that talk isn't just cheap. A lot of the stuff has to do with policy. When you look at tax policy, that's going to be something that's key to this election because the Trump-era tax cuts expire at the end of 2025. And both former President Donald Trump and current President Joe Biden have been talking about taxes. Donald Trump wants to talk about lowering taxes. The current president wants to talk about raising taxes on corporations, raising the rate of a corporation that has buybacks, and also a wealth tax, a billionaire's tax, something that isn't likely to get through, but something that certainly is a rallying cry for progressives. One thing we can take away, whether or not it is Biden or Trump in the White House next year, some of Trump-era tax cuts will live on because President Biden has also promised to not raise taxes on those making less than $400,000 a year.
Briefly, Anne-Marie, how will the border play in this? I heard you do an interview earlier on with Congresswoman. Will Biden pull the ripcord on an executive order on the border? Briefly, very briefly.
He's been weighing that decision. I'm not sure if we're going to get him to come out and say that today. What he is going to likely do is what he did when he visited the southern border and invite former President Donald Trump to tell Republicans in Congress to sign up to that bipartisan agreement he struck with senators.
Anne-Marie Hordern, thank you very much for being with us. We look forward to full coverage on State of the Union, the address at 8:30 p.m. That is tonight on Bloomberg. Let's get you some sector price action. These chips are flying higher. Tech is hot. Abigail Doolittle is with me to go under the hood.
Yeah,
Abby.
In fact, all sectors are hot, Manus. We're looking at all 11 S&P 500 sectors in the green. The best materials, interestingly enough, so some nice breadth from the tech rally as well. Materials up 1.4%. Then to your point, communication services and technology, both up about 1%. The worst sector, healthcare, up nearly 0.2%. So again, bullish sector composition. Let's take a look at the banks because, of course, we've had lots of volatility recently with the regional banks in particular. New York Community Bank, that stock is sharply higher. Fitch has affirmed its BB plus rating on the company's capital infusion plans. They also finally have given an update in deposits, probably better than feared, coming in at about $77 billion, just down 5% from the last read at $81 billion. They cut the dividend. Investors seem to think that maybe at least right now it is shored up, and you can see that the overall sector, Manus, is doing well in sympathy.
Yeah, well, that's what you call whiplash, isn't it, Abby? I mean, a turnaround of over 50%. Yes, Abigail will do a little tracking. The big stories for you. Your trading diary, this is what you need to watch out for the rest of the week, and there's not much of it left. Today, the Fed Chair, Jay Powell, testifies before the Senate. Cleveland Fed President Loretta Masters speaking at 11:30 a.m. On the earnings front, we're coming near the end of this quarterly report. Gap and Costco come in after the closing bell, and President Biden delivers that all-important State of the Union address. That is at 9 p.m. Eastern Time. And, of course, we're counting down to payrolls number. The whisper number is just over 200,000 for tomorrow. That hits the tape at 8:30 a.m. Equities are bid as we wait for Jay Powell's day two of his communication to the market. The Nasdaq is flying higher. I can tell you this morning, it's a lot of the chip stocks that are on the move with real sentiment trading higher there. FTSE 100 up a third of 1%, and you also have Deutsche Börse up 0.6% as we've just had the ECB leaving rates unchanged, and the president to the ECB, Christine Lagarde, pushing back hard and resolute that they don't have the data to cut, wages are too hot, and that she will not commit to a cadence and a timing and a rhythm of rate cuts when they come. You need to think about that from a global perspective right here on Countdown to the Open. Good morning from New York.